Welcome to vTalkInsight, Risk Sentiment Daily for March 25, 2026. The Middle East energy shock is colliding with fragile risk appetite and volatile cross-asset pricing, so let's unpack what is driving today's risk-off tone. Risk sentiment has swung back toward a fragile risk-off stance. Equities have slipped again after their brief relief bounce, with the S&P 500 down modestly and volatility pinned in the high 20s, reflecting persistent concern rather than outright panic. That move comes on top of what is already the worst month for global equities in more than 3 years, and with the index now trading decisively below its 200-day moving average, technical signals are reinforcing the caution. The dominant driver of this fragility is the ongoing Middle East energy shock. Up to 15 million barrels per day of supply are still offline. Key shipping lanes around the Strait of Hormuz remain compromised, and actual physical shortages in crude, refined products, and LNG are now visible, especially in Asia. Oil and gas prices have become extremely jumpy, with intraday moves that normally take months unfolding in minutes, and that volatility is feeding through to risk assets, inflation expectations, and central bank reaction functions. Portfolio positioning mirrors this uncertainty. Many managers report a defensive tilt, with overweight cash and short-duration fixed income, wider credit spreads, and increasing concern about liquidity, particularly in private markets. At the same time, persistent dip buying, rotations into broad equity ETFs, resilient earnings, and structural themes such as AI infrastructure and the energy transition are preventing a full capitulation, keeping the overall tone cautious rather than outright distressed. The first and most powerful driver today is the Middle East energy shock and supply disruption. What began as headline risk has morphed into a genuine physical shortage story, with more than 40 energy assets damaged, up to 15 million barrels per day of production and transit impaired, and LNG flows from the region cut by about 20%. In oil, traders describe intraday ranges normally seen over an entire year, while some distressed crude grades are reportedly changing hands near $200 per barrel, underscoring how tight specific segments of the market have become. Control of the Strait of Hormuz sits at the heart of this risk. Gulf states see effective Iranian control as unacceptable, and any further escalation around that choke point could deepen supply losses and force more drastic rerouting. LNG is under even greater strain than oil, with multi-year force majeure declared at some facilities, coal and alternative fuels rallying as substitutes, and European gas storage already about 30% below last year, leaving importers vulnerable to price spikes and outright shortages if weather or Russian flows turn adverse. The implication is a structural risk premium in energy rather than a simple spike and retrace. Analysts now see the baseline for oil moving from around $60 to closer to $80 for several years, with scenarios that keep Brent in a $120 to $150 range if flows through Hormuz remain constrained into April. Even if a ceasefire allowed shipping to resume, damaged infrastructure and depleted inventories of particular crude grades and distillates mean the physical market will likely normalize slowly, keeping inflation pressure and macro uncertainty elevated. For risk assets, that means any rebound is tightly linked to credible signs of improved shipping safety and repair progress, while fresh attacks on key infrastructure like the Saudi East-West pipeline could quickly trigger another leg of risk-off. The second major headwind is stagflation risk and higher-for-longer rates. Energy price spikes are feeding directly into headline inflation, with estimates that the latest shock alone could add around 50 basis points to U.S. inflation this year and push consumer price growth toward 4%, or even closer to 5% in more adverse scenarios. In Europe, purchasing manager data show rising input costs, and central banks such as the European Central Bank and the Bank of England are openly flagging upside inflation risks linked to the Iran conflict. This backdrop constrains central banks from providing the sort of policy support that cushioned past shocks. The Federal Reserve is widely expected to remain on hold, with officials reluctant to give strong forward guidance and market participants unsure whether the next move is more likely to be a cut or a hike. At the same time, front-end yields have repriced sharply higher, 10-year U.S. yields have moved above 4.4%, and investors increasingly see a sustained move above 4.5% as a potential tipping point for equity valuations. Higher discount rates and policy uncertainty feed directly into asset pricing. Recent equity weakness has been driven mainly by multiple compression rather than earnings downgrades, but that process can continue if bond yields keep grinding higher or if aggressive fiscal stimulus ahead of elections unnerves long and bond markets. On the other hand, long-term inflation expectations remain broadly anchored, and the recent bond market repricing has created what some see as rare value in parts of global fixed income, particularly at maturities of 10 years and shorter. For now, though, the dominant message from rates is that capital is more expensive, policy room is limited, and risk assets are more sensitive to any growth disappointment on top of the inflation shock. The third bearish driver is private credit liquidity and credit stress. Several large, non-traded private credit vehicles have begun capping withdrawals after redemption requests exceeded 11% of assets, with a flagship $25 billion fund limiting redemptions and multiple business development companies activating gates. At the same time, a private credit fund managed by Future Standard and KKR was downgraded to junk, an unusual step that highlights rising funding costs and questions around the resilience of leveraged private lending structures. These developments come against a backdrop of widening public credit spreads. Investment-grade 5-year credit default swap indices are up roughly 15 to 20 basis points month to date, while high-yield indices have widened 40 to 50 basis points, signaling greater risk aversion even though default rates remain low for now. Concerns about information asymmetry and possible insider trading around sensitive political announcements are also undermining trust, making some participants less willing to provide liquidity just as volatility in oil and geopolitics intensifies. The risk is that stress in private markets spills back into listed assets. If high-yield spreads continue to widen and volatility spikes higher, risk assets could face significant outflows, with volatility indices potentially breaking above 30 and equities seeing another leg down. Individual names are already under scrutiny, with Jefferies, for example, down more than a third this year as investors fret about credit exposures ahead of earnings. While there is little sign of systemic crisis, the combination of illiquidity, opaque fundamentals, and tighter financing conditions argues for a more cautious interpretation of private valuations and of leverage embedded across portfolios. On the bullish side, robust earnings underpinning equity resilience are helping to offset these macro headwinds. Across large, mid, and small caps, earnings growth remains positive into 2026, and recent declines in equity indices have been driven largely by multiple compression rather than a collapse in profits. Analysts have actually raised S&P 500 earnings estimates, supported by strength in semiconductors and energy companies that are direct beneficiaries of the current investment and price environment. Valuations have also corrected from their frothiest levels. Leading AI-related names, including the so-called Magnificent Seven, have derated back to valuation multiples seen at the start of the year, reducing some of the concentration and bubble concerns that were front of mind only a few months ago. Sector performance is mixed rather than uniformly negative, with areas like retail, autos, and energy stocks outperforming while basic resources and banks lag, pointing to selective risk-taking rather than indiscriminate de-risking. Behaviorally, there is still a strong underlying bid for equities. Persistent dip buying, especially into broad index ETFs such as large S&P 500 trackers, suggests that many investors continue to treat pullbacks as opportunities to add long-term exposure rather than signals to exit. Convertible bonds are also being used to access cyclical and broadening equity upside with built-in optionality, reflecting a view that, despite near-term volatility, the earnings backdrop over the next couple of years remains constructive. The key risk to this earnings-driven resilience is that prolonged energy costs eventually squeeze margins, as airlines are already flagging, forcing downgrades that would make current multiples look less comfortable. A second important source of support is the structural AI and energy transition boom. AI data center investment is accelerating, with large new facilities being built in regions such as Texas, as companies seek both energy security and distance from geopolitical hotspots. Long-term, investment-grade offtake contracts underpin many of these projects, giving utilities and infrastructure providers better earnings visibility and helping to anchor growth expectations even as macro uncertainty rises. Major utilities are positioning themselves as key enablers of this AI-driven demand. They plan to add between 15 and 30 gigawatts of new generation capacity by 2035, spanning renewables, battery storage, gas, and nuclear, often under customer-specific tariff structures that shift much of the cost toward hyperscalers rather than households. This capex cycle is complemented by a broader energy transition agenda and by supply chain rewiring, with geopolitical risks in the Middle East and elsewhere pushing more AI and digital infrastructure investment toward perceived safer jurisdictions. For markets, this creates a secular tailwind that can coexist with cyclical volatility. Enterprise software firms with strong vertical integration and AI-driven productivity benefits are seen as better positioned than more commoditized retail software, and AI-based cybersecurity solutions are beginning to disrupt legacy systems, in some cases promising material cost reductions. While adoption of advanced AI agents still faces constraints around infrastructure, trust, and data quality, the multi-trillion-dollar investment pipeline provides a longer-term growth pillar that can help buffer portfolios against shorter-term shocks. The key question is how that secular story is discounted when risk-free rates are higher and earnings dispersion is elevated. The final bullish driver is the prospect for Iran conflict de-escalation. There are credible reports of ongoing negotiations, including a recent 5-day pause in escalation by the U.S. designed to create diplomatic leverage, and suggestions that Iran's military capabilities have been significantly degraded and that it may be willing to accept constraints on its nuclear ambitions. Arab states are actively pressing for a resolution that would reopen the Strait of Hormuz and restore normal oil and LNG commerce, reflecting how economically damaging the current situation has become for the region itself. If a durable ceasefire is achieved and the Strait of Hormuz is effectively reopened, the impact on asset prices could be substantial. Analysts argue that most assets outside energy could retrace toward pre-conflict levels, with the U.S. dollar facing renewed selling pressure and risk premia in equities and credit compressing as tail risks fade. Medium term, many observers see incentives for key global powers to avoid escalation, which supports a base case of gradual de-escalation even if the path is uneven. However, this de-escalation narrative remains fragile. Israel is still publicly committed to its military objectives. Iran's leadership vacuum and hardened regime stance create unpredictability, and additional U.S. deployments alongside possible Saudi and UAE involvement keep the risk of miscalculation high. Markets have already seen relief rallies reverse as new reports of strikes and troop movements emerge, and oil remains near the low 90s despite talk of diplomacy. For now, that leaves de-escalation as a powerful upside scenario rather than the central case, and keeps risk appetite highly sensitive to every headline out of Washington, Tehran, and the Gulf. To sum up, today's risk backdrop is best described as fragile risk-off. A severe Middle East energy shock, rising stagflation risk, and emerging stress in private credit are weighing on valuations and keeping volatility elevated, even as robust earnings, a powerful AI and energy transition capex cycle, and the possibility of Iran de-escalation offer important sources of support. For portfolios, that mix suggests a market finely balanced between downside shocks from geopolitics and rates and upside scenarios tied to earnings durability and structural growth themes, with headline risk likely to dominate short-term moves. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.